And on today's show, how charitable planning strategies can reduce the tax bill at death. Part 4 of this week's series on estate planning update for 2015 with author and top producer Mike Kilborn, CLU CHFC. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to InsMark, Life Specs, and Backroom Technician. Let's get down to business. Well, welcome to day 4, Mike. And
thank you.
All this week we're talking about your ideas. You play in a huge arena. Many of your clients are 20 million plus clients. You're a top of the table producer, you're an author, you're a speaker, and this is really all you do. A lot of other planning, but this is your wheelhouse. And especially within that wheelhouse of estate planning, you are all over this idea of charitable planning strategies.
Yes, in fact, the idea we're going to discuss shortly is pretty much in many, I won't say all, but in many of the plans that I do, and not for the uber wealthy. We're talking, there are clients with assets of states less than the exemption amount that still use the kind of planning, this charitable planning that we're going to talk about. In fact, what you need to do is to teach your clients how to direct their own social capital. What's their social capital? Well, that's what they earn and they own, but they don't get to keep. I mean, you die and things go to your heirs, but unfortunately, some money has to go to Uncle Sam or charity. I mean, if you had to pick between those two of those three, which two would you pick? And I think most people would pick to charity. In fact, one of the best tools is called a Charitable Remainder Trust. And the Charitable Remainder Trust is very much a synergistic tool. It provides a benefit to charity, but it takes care of you while you're alive. And at the end, we're going to show you how to take care of the family too. It allows you to, the grantor, to avoid capital gains tax. So you can now put an asset into this Charitable Remainder Trust, and you can be the trustee of the trust. Your client can. And then they can sell the asset, and there's no capital gains tax. Well, think about that. If you sold it without doing this, you pay capital gains tax, and you've got what's left, and that earns an income. Now, if you have no capital gains tax, you're able to have the income on a larger sum for your lifetime. And we'll talk about that. So you have an income coming from the trust while you're alive, and at your death, it goes to charity. In fact, you can have it last for your life and your spouse's life. In fact, you can expand upon that, even throw in a child or two for their lives. It leaves the grantor in control because the grantor can be the trustee of the trust. And it helps them diversify their assets, because if they put something in here that was maybe a piece of real estate or one single stock, huge, now they can sell it and put it in several stocks because they're in control. They're the trustee of the trust. It protects the assets from the claims of creditors. And it provides a source of greater income for their life, because as I suggested, now they don't have to pay capital gains tax because they're putting it in the trust, and they're going to create an income from the asset once it's sold inside the trust. It provides a tax deduction. But people say, my goodness, the full amount? No, it'll be present valued using the government's tables, because they have to take subtract the present value of the income interest that you'll receive, but it still provides a substantial tax deduction, which if you can't use it in this year, you have 5 additional years. So there's a total of 6 years you can use the deduction.
So you can push this forward.
Yeah,
so if you didn't use it this year, you hit the cap.
Right.
You still have the leftover residual the next year, and whatever years you need, you could use up to 5 plus the 1 your original year. Wow.
And so let's say you had a $300,000 deduction to use. Well, let's say your adjustable gross income is $100,000. Well, with a Charitable Remainder Trust with appreciated assets, you can only deduct up to 30% of your adjusted gross income. So what do I say? 100,000, 30% is 30,000. So I can only deduct 30,000 this year. So I'm going to need to get 300,000. I probably have too much going in. I've got to have to adjust it backwards so I get the full deduction. So we actually work from the deduction backwards as to see how much to put in here in year 1. So it allows the grantor to leave a legacy to his favorite charity, possibly his only foundation. So let's walk through how this works. Basically, you have your donor. You make the Charitable Remainder Trust, set it up, and you gift property into the trust. You have an income coming back to yourself, and you get a charitable deduction. And by the way, what you can do with that charitable deduction now is make gifts to a trust called the Wealth Replacement Trust. Maybe we'll buy life insurance in here to replace the wealth that's going in the Charitable Remainder Trust, because at the end of the day, if the charity gets it, people may say, well, I've just disinherited my kids. Well, we're going to take care of that. We're going to let Uncle Sam pay for much of it by giving you a deduction and use it to buy life insurance, so that in effect the life insurance policy comes to the beneficiaries through the Wealth Replacement Trust.
So you're paying for it with the tax savings, you're paying the premiums of the life insurance through the tax.
And maybe some of the income, but you've got more income than you would have had, and at the end of the day, the beneficiaries may be better off than they were before, because now they've got the full amount where it would have been reduced by estate taxes and income taxes and possibly in your estate. This is a wonderful tool. Now let's go up here, and I'll show. This is a good example. I had a lady that had a $22 million estate. Actually, she came to me, and we had some discussions, and I met her about 2 weeks later, and she said this bank stock she had, and I'm thinking it was Comerica stock, Comerica Bank at the time, and it was her dad had given it to her, believe it or not, one certificate. And she told me it had appreciated 22%. So I said, you mean the $10 million is now worth $12 million too? And she said, yes. I said, you know, I have a great idea for you. Let's just move your mind back 60 days. Remember that you had a $10 million worth of stock back then. Let's take the $2 million, $2.2 million gain that you have. Let's transfer it to a Charitable Remainder Trust. Let's have a 10% payout, so she'll have $220,000 a year. We'll buy a life insurance policy of $6 million to pay the estate tax on your entire estate, and all you had to do was move your mind back 60 days. So at the end of the day, your heirs will end up with about $19,800,000, and your family foundation will end up with a great deal of money. That was a wonderful tool.
This is a huge strategy and how easy is this to learn as an advisor?
This isn't difficult. In fact, in my book, I covered, it's so simple. I covered it in an easy to understand way. We'll talk about disinherit the IRS.
We'll be right back after this break with more from Mike Kilborn on how to use these charitable tactics and strategies with your client. It's not how much money you make for your clients, it's how much money they get to keep, especially in retirement. But retirement income could cause Social Security benefits to be taxed. One tax advantage alternative is life insurance designed as a non-modified endowment contract that can generate tax-free income without taxing Social Security benefits. These contracts offer differing funding options depending upon your client's risk tolerance. For more information on how life insurance can be part of your retirement planning, just email me at steve@downtobusiness.tv. Brought to you by Ash Brokerage, the practice enhancement company. Well, welcome back to our second segment. Of course, we're with Mike Kilborn, and he's walking us through all the things that we're talking about this week, and it's all included in his book, Disinherit the IRS, which is you can purchase it on disinherittheirs.com. You can pick this up at Barnes & Nobles. You can go to out on Amazon.com and pick it up. And I like it because it's really easy read. It's not technical jargon. I thought it was going to be legal, language. It's got the good legal language you need, but it's really easy to understand. And he's got a patented vocabulary. I love the glossary because it really helps me. If I get lost, I go, I got to look at that up again. I can bring myself back up to speed and update my understanding of the terms that he's using in this book. Great book.
Oh, thank you.
Well, let's walk through the balance sheet on this.
Right, we were talking about Charitable Remainder Trust, and I thought it'd be good to look at the difference between not doing it and doing it. So without a Charitable Remainder Trust, well, let's say you have a $1 million asset. Okay, well, no gift to charity, so essentially your capital gains tax is paid, and state and federal, and then now you have a net asset of roughly $756,000. Well, at 7% income, let's say you could get that. There's $52,000 a year, and at the end of the day, your children will get the $756,000, but they have to pay estate tax because you have a large estate, and so the children are going to get $453,000. So over the years, you'll have had the income of $52,920. So we've got a lifetime income of about $1 million, plus what the kids get going to your family. And that's a total of $1.5 million. Well, let's go over here, and you've got a Charitable Remainder Trust. You gift it to charity, or actually move it into your Charitable Remainder Trust, but during your lifetime, you'll get to get an income. Well, how much income? Well, we're going to say it's a 7% payout. You're earning 7%, so it's $70,000 a year, not $52,000. You get a deduction, $300,000, tax savings of $120,000. So that means that those tax savings plus a little bit of the income will purchase a $1 million life insurance policy, possibly a second to die, that will end up being the children's inheritance, income and estate tax free. So they get $1 million. You get $1 million, 20 years, it's 70,000 years, $1.4 million of income. Kids get $1 million. Charity gets $1 million. Who knows, may grow a little. At the end of the day, that's $3.4 million. Compare it to not doing it, and you look at this and say, my goodness, why wasn't everybody doing this? Well, if they have a decent estate size, this makes perfect sense. In fact, we go so far as to say you can use this technique as a retirement tool. So you put a little bit in every year. No ERISA rules. You can discriminate. You can retire whenever you want. You can put as much in every year as you want, and it accumulates. Every year you get a little bit of deduction. That helps, but in the meantime, you've got these things going in, and when you're ready, now we call that a NIMCRUT, because you're not going to have a payout. We're not going to say 7% comes out. We're going to net income with Make Charitable Remainder Uni-Trust. So we're going to take this Charitable Remainder Uni-Trust to a new level, and we're going to actually keep an accounting of what we're not paying ourselves that we're supposed to. If we're supposed to pay ourselves 77% of the trust as revalued every year, let's say that's $70,000, we're going to keep that in a column, and we're going to keep track of that. And so when you get to the day you want to retire, you've got this accounting that shows you've got all these dollars you didn't pay yourself over the years, and now you start producing an income. Maybe you sell some assets, maybe you put it in dividend-producing stocks, whatever. You have to pay yourself the 7% plus whatever's in the makeup account. So now there's your income in retirement.
Well, this is a huge balance sheet issue. I mean, when you look at at the end of the day, you're talking twice the amount of money.
Yes.
Leveraging charitable. What other ones do you want to show me before we close out our show today?
Okay, I wanted to just mention that there's a Charitable Remainder Uni-Trust, so that's based on a percentage that you select. It must be at least 5%. And you want to pay, you know, it's interesting. When I was doing my own charitable trust, I told my attorney I wanted a 10% payout. He said, no, you said you ought to choose the 6%. I said, why? He said, well, you're younger, so you'll get, if you get a lower percentage of a growing number, he kind of proved it to me that you get more income. So I ended up at 8%. But so you don't, choosing a larger percentage doesn't always get you more over a lifetime. So that's a Unitrust. But then there's a Charitable Remainder Annuity Trust. And that's a different animal. Here you actually choose a percentage, but just the first year. So you say, okay, I want 8% the first year. That's $80,000. And now, after that, it's $80,000 every year. Well, people say, well, what if it doesn't produce, the trust doesn't grow or produce the 8%? Well, then you take from principal. Yeah, the charity's going to get a little less, but that $80,000 must be paid every year. And this might be very good for an older client. If someone was in their late 70s or maybe in their 80s, I would say, let's look at a Charitable Remainder.
Well, I kind of like this because you're not dependent on performance here. If you have to dip into principal, you have to dip into principal.
Right. This annuity trust doesn't keep up with inflation where it would in the Charitable Remainder Uni-Trust because you chose a percentage. And then last of the three, and I started going over it just a moment ago, and that's the NIMCRUT. And that's a net income with makeup, Charitable Remainder Uni-Trust. So net income with makeup, as I suggest, is a wonderful tool. It pays the lesser of your payout, the lesser of the earnings of the trust or the chosen percentage. And so what we do is we select maybe growth stocks, doesn't pay anything, or we choose variable annuities. They don't count the income, so it doesn't pay anything, so to speak. And then we let that accumulate, and we keep track of what we didn't pay ourselves that we were supposed to. The $80,000 I mentioned keeps growing, and then we see that we've got this huge makeup, and when we're ready, we can take it out. And I suggested earlier that maybe we could make that a retirement tool. What a wonderful thing you could turn this.
So I don't have to take my income then. I can let it accumulate.
With a net income with makeup.
If I want to be able to take it out in a lump sum or a part of it, I could.
Oh my God, what a wonderful tool.
Wow.
This is, a lot of people realize that, you know, I've got a guy owns a business, and he only has 2 or 3 employees, and he wants a big plan for himself, but then he realizes he's got to make sure everybody in his firm is equally treated and all that. Here, the ERISA rules don't apply. You can set this up for yourself and completely discriminate and set a charitable, and you're doing good because you're doing good for yourself and you're doing good for charity.
Well, that's all the time we have for today. Remember, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? Just go out to our video archives. And remember, you could be wiser as an educated advisor. I'm Steve Savine. We'll see you.